Hi guys, I'm Margaret and I'm a CPA here to help you with your wealth creation process. Today we're going to be talking about 5 basic and fundamental tax tips and strategies that you need to know in order to create wealth and be financially stable or retire early, whatever it is that you want to do. So keep on listening. Okay, so the first tax tip that I have for you all today is that how you make your money is actually sometimes more important than how much money you make. And you're probably like, what do you mean by how you make your money? A lot of people are taught in school that the correct path to follow is to get into a good school, get a college degree, and then try to go for the highest paying job possible and try to really make a really great corporate career or something and try to invest all that money into stocks and save for retirement. But the truth is, having that job, that corporate job specifically, a W-2 job as you call it for salaries and wages, is actually one of the worst methods you can use to make money because there are virtually no tax advantages for that. Let me tell you why. The government incentivizes literally anything else over a W-2 slave wage job because you, unfortunately, as an employee to the government, are not creating opportunities for others. Tax rates and loopholes are really different depending on how you earn your income. Someone making millions of dollars can pay less taxes than you, and you're not $1 million job, I'm assuming, if you're watching this video, because how they earn their income is very different from how you earn your income. As an example, someone making $500,000 from rental properties is actually netting a very different amount in their bank account from someone making $500,000 from a W-2 salary or wage job. As a thought experiment, note that let's say we have 2 types of people. One person makes $260,000 from rental real estate, and another person makes $500,000 in compensation from their really high-paying corporate job. Who do you think actually has more money in the bank account? Who do you think pays more or less taxes? Well, I'll give you a second to think about that. The truth is that these 2 people can actually make the same amount of money, and they will have the same amount of money going into their bank account at the end of the day. Because the unfortunate truth is that corporate jobs are taxed at the highest level. The federal and state tiered taxing system goes really hard. It can really be up to 50% of your whole income. It's just completely wiped out by taxes, especially the higher your waged income goes. Okay, so the next tax tip that I have for you all is that home ownership brings a lot more tax advantages to you than renting a property. A lot of people are stuck between whether or not they should rent a property or if they should buy a property. But as I've mentioned before, the government encourages anything that creates opportunities for others, and renting someone else's house, unfortunately, does not create opportunities for others. However, if you buy a piece of property that you live in, you can get tax advantages such as deductions on things like your mortgage interest expense, or property tax. Furthermore, if you end up deciding to sell your property down the line, if you're single, you can exclude $250,000 of your gains from taxes. That's $250,000 of tax-free income going straight into your bank account right there. Or if you're married, you can exclude up to $500,000 from the gain of the sale of your property from taxes. This is on your principal residence, and you must have lived in it for 2 out of the last 5 years. Even further, the government provides incentives to people who are low-income first-time home buyers because they do think that it is less of a liability for them to own houses at an older age compared to renting at an older age. And what I mean by liability, I mean a liability for the government to take care of you. So that's why the government encourages you to buy a home instead of renting. Obviously, one step further to personal home ownership is buying rental properties for other people to live in, and that is a fantastic way to increase investment income, and there are tremendous amounts of tax advantages, even more so than property ownership as your personal residence. The next piece of advice I have is to maximize your contributions to accounts like retirement accounts that defer your taxes or are straight up tax exempt. Accounts that defer your taxes are 401ks and traditional IRAs. You don't pay taxes when you contribute, you only pay ordinary income taxes when you withdraw the money from those accounts. These help you defer your taxes, and in the meantime, you can invest your pre-tax dollars. Accounts that are tax exempt are things such as Roth 401ks, IRAs, and 529s. You pay tax now, and then you don't pay taxes later when you take out the distributions from the accounts. The next piece of advice I have is to make sure that you're looking at the advantages of long-term capital gains. I know this one's really basic, but sometimes people really do need to hear this one, which is that you obviously pay way less taxes if you hold investment items or properties for over 1 year at least. I'm looking at the day traders and house flippers who think that they are getting away with making a lot of money, but you're not really, because you're paying ordinary income tax rates, when instead you could hold your properties for over 1 year and pay up to 20% maximum taxes on what is classified as capital gains. Anyways, what I'm saying is that if you're holding things for the short term, it's really important to consider what you are actually making after tax instead of before tax. The last tax tip that I have for you all is called 1031 exchange, like-kind exchange. And you're probably like, what is the benefit of a 1031 exchange? Why do I care? The goal of this is basically to defer taxes. Let's say you want to get rid of your current property and you want to get something new up in here. You have this old house that completely got depreciated and you want a new house, but you don't want to pay taxes on the gains of selling your old house right now. What you can do is a 1031 exchange where you defer the gains of taxes to a later date. What you do is take an investment or business property and exchange it for something of equal or higher value. And then that way you can defer your taxes. It's also important to note that there are certain types of properties that are not included in the 1031 exchange treatment that I will have listed here. Okay, so those are my 5 basic fundamental tax tips that you need to know for wealth creation. Let me know what you think in the comments down below, or if you applied any of these tax tips to your own life, and I'll see you in the next video.